This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Monday, September 8th, 2014. I'm Lee Adler. The last time we got together was 2 weeks ago, and I thought for sure, taking a week off, that we would have a lot to talk about. But on that day, which was Monday, August 25th, the S&P closed at 1998, and here we are just about 10 minutes ago as I was recording this. At about 2:30 p.m., the S&P was once again 1998. Now, a lot of times over a 2-week period, we see a pretty big swing, but this market has been stuck in neutral, hasn't moved at all. So what's there to talk about? Well, last week we did have some big news. We had the new lending program announced by the European Central Bank, and also we had the jobs data. So I'm going to get into that, and we'll look at how that's likely to impact the market in the weeks and months ahead. So one of the things that I've been wondering about is whether the ECB would take the handoff from the Fed when the Fed wound down QE, and that'll take place over the next couple of months, sometime between October and December. Super Mario last week made the announcement that indeed the ECB would begin a program of asset purchases. However, he did not say exactly how much those purchases would amount to. They did say that they would begin in October. So apparently there is going to be a handoff. The ECB will begin asset purchases as the Fed winds down QE. Now, as we've discussed in the past, there are differences in how the ECB operates and how the Fed operates. And I would refer you to the program I posted, I believe, on June 6th regarding the last ECB scam. In this case, the ECB again announced a cut in its lending rates to another 10 basis point cut. I believe the new lending rate is 5 or 10 basis points. It's kind of irrelevant at that rate. But they also increased the negative deposit rate so that banks who are holding reserves will be paying an additional 10 basis points, now a total of 20 basis points, to hold their funds on deposit at the ECB. Now, the banking system as a whole cannot withdraw those deposits. The only way they can be extinguished is if the loans that created them, the ECB either LTRO or medium-term or short-term lending operations, if those loans are paid off, then those deposits get extinguished and the banks no longer would have to pay that interest. The lowered loan rate and the increased negative deposit rate results in a net wash in the cost of funds to the banks that have these ECB loans outstanding. But in the absence of other profit opportunity, in the absence of a carry trade, for example, the U.S. Treasury carry trade that worked so well for them for so long, in the absence of that, as they expect higher yields on U.S. Treasuries and lower prices, that looks less appealing. So there's still an incentive for the ECB banks to pay off any outstanding loans that they have from the ECB and extinguish deposits. And in fact, since the ECB began its program of negative deposit rates in June, in fact, the ECB's balance sheet has continued to shrink as the banks that participate in that system continue to deleverage under the weight of an immense amount of bad debt. So the incentive will be for continued deleveraging. So what will happen when the ECB begins its purchases of asset-backed securities? What they want to happen is for the banks to increase lending. But if you don't have qualified borrowers, you're not going to lend. Again, this is something that we've discussed in the previous program. So what's going to happen is most likely a continuation of the pay downs of any outstanding ECB lendings. The banks, when they sell these asset-backed securities to the ECB, they're going to have cash, and they will then be enabled to use that cash to pay off existing lending from the ECB. And as they do that, that will extinguish deposits. The ECB's balance sheet will continue to shrink, and this program will again result in a failure to stimulate inflation or any economic growth in Europe. The problem there is still the massive overhang of debt, and that problem is not going to go away until there is sufficient deleveraging that the banking system gets healthy again. And that, I'm afraid, is not going to happen unless we return to some rational system of returns, of investment returns. If all investment returns are zero, then there's no rational basis for real investment. It just encourages speculation, and we've seen the results of that throughout the world. You have markets going higher, but economies remain stagnant. The U.S. economy has been an exception thanks to the benefit of the massive energy boom underway in the U.S., but the rest of the world has continued to stagnate in spite of massive amounts of QE and zero interest rates. So I don't think the new program from the ECB, Super Mario's newest con, is going to make any difference. I think that the ECB's balance sheet will continue to shrink, and that the resulting purchases, the cash that the ECB forces into the system, may not make its way into the markets. This is my operating guess at this point. So I do believe that the only player left who actually will be purchasing securities and forcing funds into the system will be the Bank of Japan. Now, that'll be enough to keep things percolating with more up and down swings, but I don't think it'll be enough to drive the markets to significant new highs. Now, again, this is just a guess. If I'm wrong, we'll know at some point in October when the ECB begins this program. First of all, we're going to have to see what the amounts are. If they're token amounts, 10, 15, 20 billion a month, I don't think they're going to make any difference whatsoever. If they're in the 50 to 60 billion dollar range or more, then they could make a difference. And if I'm wrong, we'll begin to see the markets strengthen. Most importantly, we'll see the ECB's balance sheet begin to expand again. If the ECB's balance sheet doesn't expand, then the markets are going nowhere. If the ECB's balance sheet begins to expand, it would mean that the banks are not paying off these loans, and instead they are redeploying the cash into the financial markets, just as the U.S. primary dealers and Bank of Japan primary dealers have done. The U.S. is still the most attractive game in town. It's the last Ponzi game standing. If these institutions don't see opportunities on their home turf, and they probably won't, then these funds are going to, again, flow into the U.S. market. They may drive down Treasury yields. I'm kind of thinking, based on the technicals that we see with Treasuries, that that's not going to happen. The 230 level is critical there. As long as they're above that, then we're not going to see lower yields. And particularly if the 10-year drives above 250, 260, then we're going to see higher yields. So the issue is, will the ECB's balance sheet expand? And if it does expand, then we should see some corollary action in the S&P 500 moving to new highs. So it's going to be interesting. Do we need to get this right in advance? No, because the markets respond to the actual cash flows, not to the anticipation of those flows. Whatever front running there is, there may or may not be right or wrong. And if it is correct, it's normally a nominal movement in the market before the actual cash flows begin. So we're just going to have to sit tight until the ECB actually begins this program in October, and we'll have to see what the ECB's balance sheet does and how the markets respond at that point. The other news of note last week was, of course, the jobs report, and non-farm payrolls came in at 142,000 on the headline number. That's the seasonally adjusted month-to-month change. It's a nonsense made-up number, and that disappointed the market. The actual data showed a slightly different story, still very much on trend for the non-farm payrolls. However, the growth in full-time jobs continues to underperform. So whatever jobs are being created are not high-quality, high-paying jobs. There are a lot of these part-time jobs, low-pay, low-skilled jobs that really don't advance the economy very much. But the employment data really is neither here nor there. The issue is whether the Fed is going to continue the taper. And unless there's some kind of a blockbuster surprise in the economic data, a negative surprise that shows the economy to be much weaker than it is, then the course is set. The Fed is going to end QE, and that's what matters to the markets. And I don't think we're going to see any economic surprises. The key data point that I look at is the federal withholding taxes, and I cover that every week in the Wall Street Examiner Professional Edition, which most of you subscribe to. And you see that chart week in and week out. If you don't subscribe, if you're a serious investor, if you're managing money, I think that this data will help you gain an understanding of how these things work together. We saw a slight softening in these collections in the second quarter. It was a little softer, but it's still a very strong number. And now, in the third quarter, the withholding taxes are now running at a real rate of gain of somewhere in the 3.7 to 4.2% range, which is, a rip-roaring, red-hot economy. The problem, of course, is that most people are not participating in that. Most of the gains are coming to those at the top of the wealth and income spectrum, and that is distorting the overall picture. It makes the top line look very good, but the majority of Americans are lagging behind that, and they're not participating in the gains. And ultimately, in the long run, that's not good for the economy. But once again, what matters is there anything in this data that is going to cause the Fed to change direction in any way? And clearly, if the underlying data remains this strong, then the Fed is not going to do anything to deviate from the ending of quantitative easing. It will still be pumping about $15 billion a month into the accounts of the primary dealers next year as the Fed continues to buy paper as a result of the MBS reinvestments every month. Some of its mortgage-backed securities holdings do get paid down, and the Fed reinvests that cash, and that cash goes into the primary dealer accounts. $15 billion is not that much, but it's a heck of a lot more than the 3 to 5 or 10 billion that the Fed might have injected during periods when there was no outright quantitative easing. So the Fed's balance sheet will remain level, and it will continue to inject some cash into primary dealer accounts, and we'll have to wait and see what the ECB, what the effects of the new ECB programs will be in October. So that about covers it for now. Now, next week on Monday, I'm going to be on the road. So the next program, the next Radio Free Wall Street program, will be posted on Tuesday, September 16th. Until then, have a great week, trade sane, and I'll see you a week from Tuesday.